Very good morning to everyone. Good morning.
Good morning.
Good morning. Please switch on the videos. Yes, switch on the videos fast. Okay. So, what are we discussing in accountancy now? Which is the chapter? Yes? Yes, fast.
Theory base of accounting.
Theory base of accounting. Okay, that is the chapter. And what is it all about? Yes? What are you learning in that chapter? Yes, please. What are you learning?
Basic accounting concepts.
Basic
Accounting concepts.
accounting concepts, only the concepts?
Then generally accepted.
Very good. Generally accepted accounting principles. What are they? What is generally accepted accounting principles? What do you understand by that? GAAP. GAAP. What is that? Please switch on the video. Those having trouble with the net, please give me a message.
Maintaining records.
Yes, Krishnanuni?
Is it maintaining records?
Okay, maintaining records. What is that?
You need to maintain uniformity and consistency.
Very good. Right answer. Who's giving the answer? Abdul Aman? You?
Yes, ma'am.
Yes, very good. Yes, in order to maintain uniformity and consistency of the accounting information, certain rules, regulations, principles, etc. are followed. They are called generally accepted accounting principles. Okay? And tell me, we had a classified gap into two. Which are they?
Concepts and conventions.
Very good. Accounting concepts, accounting conventions. Okay. Now tell me some accounting concepts. One of you will say a principle and you will explain. Yes, Krishna Kanti, start. Tell me about a principle.
Business entity concept.
Very good. Business entity concept. And what is it all about?
It says that business and the owner are have separate existence.
Okay, yeah, they are separate entity. Okay, very good. Now, next one. Who's going to tell me the next one?
Money measurements.
Money measurement principle. Right. Krishnanuni, tell me what is it all about?
Transaction have organized.
Which are in the monetary terms only should be recorded. Okay. Money measurement concept. Then next one. Yes. Money measurement concept, business entity concept, that's all. Yes, Nestle? Yes, Anish. Okay. Going concern. What is it about? Going concern. What is it?
Business carries out its operation definitely for a long period of time.
Long period of time, right? It is expected that the intention of the owner when starting a business is that the business will continue for a long period of time. That is going concern concept. Okay. Next one. Okay, those who are giving me the message in the chat box, I am seeing that. Okay, I understand. Then, Going concern is over. Next one, quickly.
Accounting period.
Yes, say. Krishnanuni, yes.
Accounting period concept.
Accounting period concept. What is that?
The tax.
Accounting period. What is the duration? The time.
The tax request income statement should be prepared annually.
Annually means at the end of an
Every year.
accounting period, which is 12 months time, 1 year. Okay, majority
1
are
year.
having a network issue today due to heavy rain. Okay, I'll share the screen. We'll revise quickly. So GAAP, generally accepted accounting principle, they are the rules and guidelines adopted for recording and reporting business transactions, and this is to maintain uniformity and consistency in the preparation and presentation of financial statements. Okay, which are the financial statements? Yes, Rahul? Remember the financial statements?
No, ma'am.
Profit and loss account and balance sheet. Okay, trading and profit and loss account. Trading and profit and loss account, and that is one. Next one is balance sheet. They are the financial statements. Okay. So generally accepted accounting principles, we classify them into two: accounting concepts, accounting conventions. Accounting concepts, separate entity concept, already said. Money measurement concept over. Going concern concept over. What is dual aspect concept? Who's going to explain? Yes? Dual aspect. What is that? Alan Thomas, can you? Alan Thomas, are you there?
Yes, ma'am.
Yes. Tell me about dual aspect concept. Every transaction, all the transaction involves two aspects: giving aspect as well as receiving aspect. Okay, receiving aspect is called, what is that called, Pavitra? Receiving aspect? Yes, debit. Receiving aspect is called debit and giving aspect is called credit. When we express this in the equation form, how do we express it?
Asset equals to liability plus capital.
Very good. Asset is equal to liability plus capital. Okay. Now, cost concept. What was cost concept? Cost concept means we record the amount of something at the price which it was purchased for, and this cost price includes not only the price given in the price tag, it also includes the transportation cost, the installation cost, everything together is the cost price. Okay, now dual aspect concept, very important, you should know this. This is the base. Okay, now that is over, and which was the next one? Next one is revenue recognition principle. Revenue recognition principle or realization concept. That means a revenue is recognized and that should be matched with the expenses incurred in the accounting period, and it is also similar to the accrual basis. Accrual basis, that means once the transaction has taken place, we will record it immediately. We are not waiting for the cash transaction to take place. That is revenue recognition principle. Then matching concept. Matching concept. That is, all revenue earned during an accounting period that should be matched with the expenses incurred. Revenue should be equal to the expenses incurred. That is the matching concept. Full disclosure. What is that? Full disclosure concept. Full disclosure, from the word itself it is clear. Full disclosure means everything, all the details regarding the financial matters, it should be fully disclosed. Nothing should be kept hidden. Do not hide anything. All important matters, everything related to the financial accounting part should be disclosed. That is what full disclosure says. Consistency concept. What is that? Consistency. Consistency means if we have selected a particular accounting method, if any method is chosen, then that same method should be followed throughout. We cannot change the methods frequently. You understand? Remember why no one is revising? That is consistency concept. I had asked you to prepare one word questions. Have you all done? Forgot? Who have done it? May I know who have done it? I had asked you to prepare one word, fill in the blanks type of questions from the chapter. Please switch on the videos, everyone. Yes? Nobody has done it? Nobody has prepared? Yes, Pranav, you?
I'm only 3 or 4.
You prepared 3. At least 3 you have. Okay. Why? What happened to others? Okay. Consistency concept. Okay. So that is about consistency concept. Any method, whatever method is opted by the organization, that should be followed throughout. Okay. That is then conservatism concept. Conservatism, other name for conservatism is prudence. Prudence principle. Don't forget, that day also, previous day also I was telling you, conservatism, other name, prudence concept. What is this prudence concept? Rose? What is prudence concept? Conservatism.
It's the guidance for recording transaction.
Uh,
Now,
Once again, please repeat.
now it's like a guidance for recording all the transactions.
It is a guidance, and what does it say? What is it about? It says, do not anticipate profits, only losses. Anticipated losses we can record them, but do not record anticipated profits. Anticipation means what? Expected. Okay, if we expect huge profit, it is just expectation. Are you sure you will definitely get this profits? The expected profit, are we sure about it? No, but at the same time it is always good to anticipate losses. If we expect loss and if it doesn't take place, it is good for the business, isn't it? Am I right? You are expecting loss and you are working for the loss to not to take place, and the loss is not taking place. That is a good thing. At the same time, you expect huge profits, and when you won't get it, how do you feel? Yes? You expect the question paper to be very easy. Expecting the question paper to be very easy. You are expecting profit. You are expecting the question paper easy, you will get full marks, And if it is not taking place, if your dream doesn't come true, what will be your feelings? Will you all disappointed? At the same time, you expect your question paper to be very tough. I have learned it very well, but the question paper is going to be tough. And you receive a easy one. Then how do you feel? Yes? Same thing. When you anticipate profit and if you are not able to achieve it, then it will be a great disappointment for the business. So it is always better not to anticipate profit. At the same time, provide for all the possible losses. Okay. So what we do is, we are expecting some profit, we are expecting losses in future, and whatever profit we get, out of it a certain amount is kept aside. We will kept it as reserve. Okay? You understand? We keep a particular amount aside for what? To meet unexpected losses in future. Yes, if we are expecting huge profits and if we are not moving aside a certain amount of money, then how are we going to face the unexpected losses? Do you understand what I say? Yes or no?
No, ma'am.
No?
No.
Who's that? No? Krishanundi, are you?
Yes, ma'am. Yes, ma'am.
Yes. Tell me, what is your problem? Where do you find it difficult? Tell me.
That when we are gaining profit, we don't know how we get, like the question paper thing you asked now.
Yes.
We don't know it's easy or not, that's one.
Yeah. See, let me ask you. You are having an exam and you expect a very easy question paper and you are sure that you will get full marks. Okay? Now, let us relate that to profit of the business. You will be happy when you get easy question paper. Am I right? Similarly, coming to the business is expecting huge profit. Okay? So, that is your expectation only. Am I right? It is not going to, it is just your dream. Your expectation. Okay. Now, when you find, okay, you are expecting easy question paper, but the question paper is tough. Then how do you feel? You will be alarmed, you will be stressed. Yes? Will you be stressed? Oh my God, I expected an easy one. Look at the question paper. It is full out of syllabus or it is very hard. How do you feel then? You will be upset. You prepared so well. You expected the easy one, but you are upset. Similarly, coming to the business. Okay? If the business expect huge profits, it is expecting. Okay? And when it is not, when they don't receive it, how do they feel? The business. The business will also be disappointed. Am I right?
Ma'am.
Yes or no?
Yes.
Did you get it?
Yes.
Yes. At the same time, just think of the reverse. You are expecting a tough one, a tough question paper. You have prepared well, you do every work correctly, but you, inside your mind, you fear, oh my God, the question paper is going to be tough. Your expectation is that. But you get an easy one. Then how do you feel? You will be happy. Am I right? So, talking about the business, the business should always anticipate loss. Anticipate a difficult question paper. Anticipate loss. Okay. So, and it is not necessary that loss will happen. We are just expecting. And if it doesn't happen, then it's good and fine. So, never, according to this conservatism principle, do not anticipate profit. Let profit come, it's good. But we do not expect it. Yes? Clear? At the same time, you anticipate loss. So here, when the loss is anticipated, what the business do is, they will set aside a sum of money as reserve. Okay, you are given a pocket money 5,000 rupees. Okay, will you spend the entire 5,000 rupees immediately? At least you will keep some amount, you will set aside some amount, and you will think it's okay, I'll use it for the next celebration or something else. Yes or no? Or will you fully spend the complete amount? That depends. Okay, but let me tell you, when you get an amount, see, the business, what they do is, out of the profit, they will set aside, move a little money, a sum of money. For what? Expecting losses. To meet unexpected risk, loss. You understand? So it is based on this conservatism principle. You are conserving. Conservation. You are setting aside certain amount of money to meet unexpected loss. You understand? Is it clear now? Yes, good. Yes, switch on the video. Sayujya, switch on the video. Okay, that is conservatism principle. Then materiality principle. Materiality principle means, according to this principle, it says only important matters is to be only shown in the financial statements. No need to show, no need for full disclosure. So this is actually against the full disclosure principle, but materiality principle says only most important things relating to the operations of the business need to be shown in the books of accounts. Okay. Next is objectivity concept. Objectivity. What was that? Objectivity concept. When accounting is done, it should be based on some proof, evidences. That evidences are called what?
Voucher.
Vouchers. Very good. Vouchers. So it is based on the vouchers that you prepare accounting transaction. You cannot do it according to your wish, your personal judgments, your personal opinions cannot overrule it. You should prepare according to the evidences given to you. I mean, the accountants should prepare the accounting books based on the vouchers, the proof of transaction. That is objectivity concept. Okay, now then we discussed about systems of accounting. What was the systems? Bookkeeping systems. We have two methods: single entry system, double entry system. Double entry system you know now. Every transaction involves two aspects: receiving aspect, giving aspect. Receiving aspect is debit, giving aspect is credit. So it is based on this rule of debit and credit that the books are maintained. At the same time, single entry system is a system where this dual aspect concept is not followed. It is not followed. Okay. So it is incomplete and unsystematic. Okay. Single entry system, double entry system. It is not complete. Now then we spoke about basis of accounting. What are the basis? Cash basis, accrual basis. Cash basis means only when cash payment is given or received. Actually, when the cash transaction takes place, then only we will record it in the books. That is the cash basis. Okay, accrual basis means once the transaction takes place, immediately it is recorded when earned, but only when actually the cash is received, only under cash basis we will record the transaction. Then we discussed about accounting standards. What are accounting standards? Accounting standards, see, it is actually the GAAP itself, but you can see in GAAP that even though GAAP provides various rules, principles, etc., again there is what? What to say, differences among same item is treated differently according to different principles. You can see in the full disclosure principle we said that everything should be disclosed, full disclosed. At the same time, materiality concept says that only important concept should be shown. Am I right? So still there is misunderstandings among these principles. Yes, you understand? GAAP, even though they give us the rules and regulations for preparing the accounting data, still among those principles also confusions exist. In order to remove that, based on the GAAP, some other standards are fixed. By whom? By a professional body. So each country will have an accounting body, a professional body. In India, it is the Institute of Chartered Accountants of India, ICAI. So each country have developed standards to be followed. That is called accounting standards. Do you understand? So what are accounting standards? From here you just have to learn this. Accounting standards are written policy documents. Take down. What are accounting standards? You should know the meaning of accounting standards. Accounting standards are written policy documents covering the aspect of recognition, measurement, treatment, presentation and disclosure of accounting transaction in financial statement. That is one sentence. Next sentence is, it is issued by ICAI in our country. Okay.
Ma'am, can you repeat first sentence?
Can you see it on the screen? It is not visible?
Make it little more big, small.
Okay. Yes. Is it okay now?
Yes, ma'am.
Okay. So from this portion, you should know what is accounting standard. Okay, what is the meaning of accounting standard? Then in India, there is a professional body, Institute of Chartered Accountants of India. It is them, ICAI, who prepares the accounting standard. Okay. Now, you can take down this. In the words of Kohler, the definition is given. Accounting standards are codes of conduct imposed by customs, law or professional bodies for the benefit of public accountants and accountants generally. Kohler is the one who have given this accounting standards are codes of conduct imposed by customs, law or professional bodies for the benefit of public accountants and accountants generally. Okay. Over? Okay.
Yes, ma'am. Finish.
Yes?
Finish. It's over.
Not over?
It's over.
Okay, thank you. I'll send the notes. You just read them, understand them. That is enough. But the question is regarding what is accounting standard. The questions that you can expect is what is accounting standard. Okay? The meaning. Then objectives of accounting standard. You can also take down this. Accounting standards are written statements. Okay, the same. Anyone, anything which you are comfortable with. You should know what is the meaning of accounting standard, and it will be good if you learn the definition of Kohler. Next topic is objectives of accounting standard. Now, what is this accounting standards for? What is the need of accounting standard? Okay? Accounting standard. Accounting standards are required to bring uniformity. What is this? So, what are these accounting standards? It is to remove the limitations of gap that accounting standards are developed. Okay, the problems related to gap. In order to solve them, as a solution to them, each country, the professional bodies of each country have prepared accounting standard. Now, so what is the objective? It is to bring uniformity. It is to bring uniformity. Objectives of accounting standard. Then it is to improve reliability. 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 You know the meaning. Reliability means what? The qualitative, one among the qualitative characteristics of accounting information. Reliable, that means it is trustable. We can depend on the account information. You can trust that accounting information. That is reliability. Now, the third point is to prevent frauds and manipulation. Frauds and manipulation by codifying the accounting methods and practices. Next, the fourth point, it will help the auditors. It will help auditors. Because in a country, all the organizations will follow the same accounting standards. So, it is easy for comparison. It is easy for all kinds of auditing works. Okay. So, objectives of accounting standard. So, what is the meaning of accounting standard? Definition of accounting standard. Objectives of accounting standard. Okay. Clear till now? Now you can see the list of accounting standards. Accounting standard 1, accounting standard 2. It is not required to learn everything. There you can find 29 accounting standards. 29 are there. It will be good at least if you know something. 3 or 4 of them. Accounting standard for fixed asset. Relating to fixed asset. Where is the accounting standard? It is accounting standard 10. AS 10 for accounting related to fixed assets. Okay, this is a list of accounting standards. You cannot find accounting standard 8. Why? Because it is merged. There was an accounting standard 8, but later on it was merged with accounting standard 26. So, intangible assets. Intangible assets is 26. I am mentioning these because you know these terms, others you are not that familiar with, that's why. Asset, fixed assets is related to AS 10, intangible asset is related to accounting standard 26. Then actually there are 32, you can see 32, but 31, 32, 30, 31, 32 is not notified by Ministry of Corporate Affairs. That's why we do not consider them. We say that there are 29 accounting standards. Okay. So just go through, just understand the terms. Slowly we'll interim financial reporting. You know that term, interim financial reporting? What was that? Interim financial statements. Interim financial statements are the statements prepared in between the accounting period. Either monthly, quarterly, half yearly, when you prepare it, then it is called interim financial statements. Yes? So, these are the list of accounting standards. You can just go through. Okay? So, it is actually 29. Again, it's given. Next is IFRS. What is IFRS? International Accounting Standard Board. There is International Accounting Standard Board. They are the standards issued by, they are also standards, the accounting standards, but these accounting standards, they are issued by International Accounting Standards Board. So here also you just have to understand what is IFRS. Don't get scared of all these, seeing all these theory part. So what is IFRS? IFRS, the term refers to the financial standards issued by International Accounting Standards Board. And what for? It is a process of improving financial reporting internationally. Financial reporting internationally to help participants in the various capital markets of the world. So, when it comes to the world, international matters, it is then we make use of the international financial reporting standards. And I told you, the financial statements usually we prepare is at the end of accounting period, we prepare trading and profit and loss account, balance sheet. Okay, but under IFRS, these are the 5 financial statements that include. You just have to know the names only. No need to go in detail. Okay. Statement of financial position. This statement of financial position is same as the balance sheet. Under IFRS, it is called statement of financial position. Okay, and comprehensive income statement, that means it is the trading and profit and loss account only. Comprehensive income statement, the other name, the name under IFRS, it is comprehensive income statement. The other ones too, the statement of cash flow, notes and significant accounting principles. Yes, you will know everything later on, not now. You won't understand it now, but later on you will come to know. And there is the main difference between IFRS and Indian accounting standards. What is the main difference? IFRS are principle based on the principles. At the same time, IAS is rule based. Then IFRS is based on the fair value. That means whatever the value it is now, the current value, fair value, that is IFRS are based on such values. At the same time, IAS are based on historical cost. I told you, cost principle, under historical cost concept, historical cost principle, the assets and everything are recorded at the cost price, whatever price they are purchased for, it is in that price that we record the assets. Okay, but under IFRS they say that they take the value of fair value, that means the present value, current value, it is that value that they consider. Okay, so let me conclude. This is all about this chapter. We have come to an end of chapter 2. Okay, so in this chapter, chapter 2, we discussed about the theory based, all sorts of theory relating to accounting information. Okay, what is accounting information? I mean, what is accounting, you know? There are various users for accounting, and for this accounting information to be useful for them, the accounting information should be in a uniform and systematic way. For that, certain rules are developed. Rules, regulation, principle, concept, conventions are all developed. They are called GAAP, and the various accounting principles. Then the system under which we maintain single entry system, double entry system. The basis of accounting, we have cash basis, accrual basis. Then we learned accounting standards, the meaning of accounting standards, objectives of accounting standard, and I showed you the list of the accounting standards. Okay, and the last topic, IFRS. What is it? Clear? So this is all about chapter 2. I stop with this. We'll see you in the next session. Thank you.